Ladies and gentlemen, please welcome the emerging markets editor for CNN Money, John Defterios.
Good afternoon. Good afternoon. That was a great panel with Ari and Hadley in a one-on-one conversation. I think we have a little bit of a challenge this afternoon. We have four excellent panels of the caliber that we have in the room in this plenary hall, all taking place at the same time. And there's a gentleman called His Highness Mohammed bin Salman, who is apparently in the building, hovering between the Ritz-Carlton and the gigantic conference center. So it's very hard to pull people into the room, but I see we're filling up as we go along. The reason I mentioned that is we're going to do a polling question before we got started this afternoon. But I want you to register with the app from the time that we start so I can ask that polling question at the very, very end. It's the heart of the question is dealing with the subject matter we're going to discuss here in the next 45 minutes, and that is how to make money in unconventional investments in this climate in 2017. I don't think anybody would argue with me when I say that valuations have been high for the last 5 years, particularly the last 24 months, built in part lately on expectations of a nice tax package coming from the United States, potentially $1 trillion infrastructure fund, low interest rates, of course, the biggest driving force, low inflation. So capital is all around, but we've had sky-high valuations in almost every asset. So in this climate where we sit at the third, fourth quarter of 2017, what should we do for 2018 in unconventional approaches to this market? We have a superb panel. It's all roundtable question and answer, and they're going to give us our best. Let's welcome them one by one. First, the Chief Executive Officer and co-founder of Canyon Partners, Josh Friedman, to the stage. Just give him a quick round of applause. Thank you. Coming out of the dark. Thank you. First seat is yours. James Faris is the President and CEO of the Institutional Clients Group for Citigroup in the United States of America. Got his Italian last name correct. David Cassidy, Executive Chairman of Canaccord Genuity Group, of course, based in Canada. Nice to see you, sir. Rugang Li, Founding Chairman and Chief Executive Officer of CMC Capital Partners, based in China. He focuses on media and has some very good insights to share with us. And we have to talk about President Xi at some point in his new consolidated power. Get ready for that question. And Tony Ressler, co-founder, chairman, chief executive officer of Aris Management, who's also in the sports business. We'll talk about that a little bit as well. There was an article circulating before this Future Investment Initiative started that said we have about $22 trillion worth of capital under management under one umbrella at the FII. It's a pretty good representation of the group here. Close to $1 trillion, probably, if I add it all up. It's not bad. Gentlemen, please take a seat. Thanks a lot for being so polite and standing there. Why don't I start with you, Josh? I had a chance to do an interview after the opening session today, and you always have interesting things to say, but I think it's a good leaping off point, if you will, for the rest of the panel. And what I wanted to start with is that you've picked kind of four key sectors, and they all have a common link of disruption. And in this market, which I talked about in my opening comments about pretty high valuations, that you have to find areas of disruption to actually get higher returns. I don't want you to lay out the whole world, but when you talk about disruption in the sectors that you're looking at, what do you think is ripe for disruption today?
Well, I think what I was saying was that there are areas such as media telecom, which we just heard this last speaker speak about, areas such as healthcare, which are enjoying regulatory arbitrage, areas such as oil and gas, where you've seen technological change, et cetera, and areas such as retailing, which are being disemboweled, as well as technology and others. Generally speaking, if you're a conventional investor, valuations have been driven largely by a decently healthy economy and a drive toward lower and lower and lower interest rates. And there's a risk of yourself becoming roadkill if you continue to follow that policy, particularly in a world where illiquidity can take place. So for us, we try to find places as value investors where we can buy $1 for 50 cents. That means we have to look for areas that are really disrupted, either disrupted capital markets or disrupted companies. The capital markets are anything but disrupted. So we look at bankruptcy, we look at reorganizations, we look at risk arbitrage, mergers and acquisitions, generally with credit-focused securities, but not only credit securities. And we also try to find things where not only is there disruption, but where there's a potential for a liquidity imbalance. And I think that the market has a false sense of liquidity right now. We have a very, very different structure, and we're very different kinds of players from the people who comprise those trillions of dollars. We're a tiny boutique with about 25 billion under management, which makes us...
consider that small.
Well, it's large in the world of boutiques, and it's very institutional, but it's very small compared to some of the speakers that we saw on the first panel, for example. And that gives us the ability to be an influential and large player in certain situations. And we also have a liquidity structure that's quite different. The last point I would make is that the death of financial institutions throughout my entire career has been when you see a mismatch between assets and liabilities. And what's been happening as a result of lower interest rates and major institutional flows is you've seen more and more money flow into mutual funds, ETFs, and other vehicles that basically offer their clientele daily liquidity. Yet the assets they're purchasing really can't be liquidated in a day. When those turn around, whether it's because the Fed starts hiking rates, because people have a crisis in confidence, whether you get a whiff of deflation, whether you get another oil price collapse. And by the way, we saw this happen in the beginning of 16, and money flows out of those funds, and the assets can't be liquidated overnight. Prices drop really precipitously when the commercial banks aren't making markets. So that's the kind of thing that we focus on.
Good, you can leap in. Okay, I don't want to go down one by one, so I'm going to go down to the other end here and bring in Tony Ressler. One thing stood out for me recently as a group, that you were in the German real estate market. Just to give a taste, I talked about the valuations we've seen in different assets, including real estate. You sold a very large plot in Munich, and then you had retail rental units, rather, that you sold off as well. Are the valuations, whether it's in Europe, by and large, or in the United States, just been climbing step by step because of lower interest rates? And the reason you sold those assets, you made good money, and you thought you'd like to reduce your property portfolio a bit?
Yeah, it was an enormously successful investment in multifamily in Germany for us, again, under the value-add real estate business, buying cash-flowing assets in an effort to make them much better, sell them at obviously a far more attractive cap rate. It has been one of our core businesses in Europe. But the bigger story, and frankly the way we've tried to create Ares management, is really trying to pursue the assets that used to be on the balance sheet of large banks. We're going where they are leaving or where they're forced to leave. And whether that's middle market lending in the US and Europe, whether that's value-add real estate, whether that's private ABS, whether that's real estate lending, whether it's other forms, if you will, of private equity, whether it's energy infrastructure. But many of these illiquid asset classes that once resided on the balance sheet of large banks, and frankly is coinciding with what Josh mentioned earlier, if you will, the rotation of capital from depositories, not just to mutual funds, but to sovereigns, to large pensions, to investment firms like those represented here. All I'm saying is that's a combination of activities that we see for the next 10 years. And frankly, that, I think, bodes well for the alternative asset manager, again, taking advantage of these illiquid assets that once resided on the balance sheet of banks and are now very much populating the balance sheets of investment firms, of sovereigns, of insurance companies, even of retail.
Okay, very good. It almost seems, James, that we have, and I know you're from the banking sector and you do institutional large clients, that there's a rush, even by the Public Investment Fund, to put $45 billion in play with a $93 billion going to $100 billion SoftBank fund, because the sovereigns want exposure to technology. They want exposure to growth, and they would like the transfer of technology, as the chairman suggested this morning in the opening panel, to lift the economy. But doesn't that kind of spell, when you have the sovereigns going after that sort of sector, and they're not alone, a bubble forming quite rapidly here, and valuations get a little bit spun out of control? Does it worry you as a banker at this stage?
Well, absolutely. I think bubbles are are a banker's absolute worst enemy, and banks aren't directly part of the investment process. We're facilitating investment. What banks really do well is lend money to the people who are making investments in asset classes all around the world. All we ever hope to do is get our money back out of that. So we're getting today mostly single-digit returns in hopes that we just get our money repaid to us. So when assets against which we are lending get very, very lofty, that's a real concern for us, of course.
Right.
Today, while asset prices are certainly a lot higher than where they were immediately following the financial crisis, there still aren't too many asset classes that just give us real cause for worry.
They're not.
There are not too many, no.
Oh, that's interesting.
We're cautious around that. There's also, I think importantly, a lot less leverage in the system today. So what Josh was describing earlier about when people are forced to sell, when these assets start to decline, and then people begin to sell them as a consequence, the real trouble starts when people are levered against those assets. And banks, the banks themselves were highly levered in the pre-crisis period. There's still leverage in the system, but it's substantially less. And even the people that hold some of these assets that Josh was describing now generally don't employ as much leverage in holding of them. So I think the risks as asset prices decline, the risk to the system is a lot less today than it would have been 10 years ago.
I'm going to pick up on our other two guests on the panel, but is that due to regulation or just why is investors getting burned so badly in 2008 and 9, Josh?
Steve Strongen from Goldman Sachs had a good quote on this a couple of weeks ago. He was in our office and he was saying that it used to be that the banks were like the castle in the middle of the village, and all of the other players, whether it were the fund managers or the individuals or whatever, the castle was there to serve all the villagers. And in 2008, lightning struck the castle and it was on fire, and everyone poured buckets of water on it to put it out. And in the last 10 years, the regulators have done such a phenomenal job at taking leverage out of the banks, forcing them to have large capital ratios, not allowing a lot of leverage, that the castle is now completely fireproof. So when lightning strikes again, it's just going to burn up all the villagers directly. And I think there's there's a lot of truth to that, because and we saw some of that in the beginning of 2016 when redemptions showed up in some of these funds. They were unable to meet those redemptions, and we saw the Third Avenue Value Fund catastrophe. And then people lost confidence and prices got really weak. Now it was very V-shaped, but it has the potential to be more severe. But in the meantime, there are enough industries getting disrupted that we don't necessarily have to wait for that kind of a market disruption. But it will happen. I mean, we're all old enough to know that it will happen.
Good. We've been spoiled, David, by low interest rates for so long that we don't know when the punch bowl is going to be pulled from the party, if you will.
Well, I think it's likely to go on. It's hard for me to see where interest rates are going to rise substantially. I was just having this debate the other day, and certainly the long rate, maybe it goes up 50 basis points over the next several years with the unwinding from central banks. But there's a lot of mitigating factors to that, where there's a lot of liquidity in the system that could sop that up. And we may not have any increase in long-term rates. And all these, what seem like bubbles, these very high asset prices in different asset classes, really flow from a very low 10-year treasury. And, as long as that sustains, it's hard to see where that's going to change.
So 0.5% over the next 5 or 6 years is what you're banking on as a firm, then?
That's what we'd mitigate against in terms of risk, but I don't think that's going to result in any type of financial crisis, and I think that can be managed.
Okay, very good. Rengang, thanks for being so patient. It's great to have the geographical spread and going to China. I wanted to ask you, also, it's a very important week for President Xi in consolidating his base at the National Party Congress. Growth has been much better than people expected, hovering around 6.5%, 7%. Let's cover that macro issue as it stands today. We were talking about risk on this panel, and there was a great concern about shadow banking before, the regional debt, and then drilling into the city debt, that this would implode and really rattle the foundation of China. Is that on your radar at all? I know you're a media investor, but the audience that's looking at China is one of the stalwart pillars that needs to be standing. Should we be concerned at all about China and its regional debt?
Thank you. I think China, today just finished its 19th Party Congress meeting, and tomorrow there will be a new leadership. The new top 7 leadership will come out. I think currently the atmosphere back to Beijing is quite positive. I'm not only talking about the political environment, but also the market environment. And in general, I think there is steady and stable economic growth can be expected. However, on the other side, like the rest of the world, I think some turbulence still there. And as you just mentioned, the city loan, the city debt, and also the shadow bank issues still happened. And but on the other side, I think China is a big market, still can accommodate a lot of issues. And you have to be cautious to some extent, because if you are too overconfident, China's market, up and down, a lot of up and downs. But in general, I think the pattern is still positive.
It's still positive. They can sustain this growth and manage this transition to the cities that are taking place. I was telling Mr. Li that I was in China for a month in February. It was extraordinary. One of the things that stood out for me is the WeChat platform, and you're in media. It's incredible. They've turned a chat platform into a financial services platform, and it's got a market of almost 900 million consumers.
Yeah.
So if you hit it big in China, and you're a disruptor like a WeChat, you really have hit it big. What are you looking at? Because I know you're a media investor.
Yeah.
You've done a deal recently with creative artists, set up a regional group in China, invested in the parent company. Tell us what you're into.
I think, first of all, China still has a lot of, let's say, underserved, potential areas. For example, we just set up a joint venture with CAA, the artist agent in the US. And before, I also set up another joint venture with IMAX, the big screen, cinema screen. And I brought this company to China 4 years ago and set up a joint venture. Actually, they spin off the China business, setting up a partnership with us. And then this company went public in Hong Kong Stock Exchange 2 years ago. Right now, the market cap actually larger than the US parent company. So you can see the potential, the big market potential in China. So that's the reason how we can leverage the global expertise back to China and really dig out the treasure, dig out the value for the Chinese market. Like Tencent, you just mentioned Tencent. Tencent is one of our shareholders in my holding companies.
Great. Tencent's the parent for everybody else here of WeChat, right? With
WeChat.
Ma?
WeChat is a social network.
Yeah.
But it's not a typical model like WhatsApp. It's a social network, but based on social network, it gradually move on to the kind of an ecosystem, aggregating a lot of news, contents. You can watch videos on Tencent. You can order food on Tencent. You can do payment on Tencent. So it's a really kind of ecosystem to combine all the activities in the society.
Great. On both ends of our panel here, we have people that are invested in energy. This is an economy that's transitioning now, but it's going to be, the great transition is going to be like 20, 30 years. I'd love to get your insights on the veracity of the shale producers, their ability to be flexible, to make money at $25, $35 a barrel today. What are you investing in? Do you stay in? Do you see prices in this new normal of $50, $60 a barrel? Tony, you want to start, and we'll come back to Josh, please.
Sure. We're very significant investors in the energy industry. I mean, everywhere from power to midstream, certainly to oil and gas producers. I don't know if most shale producers would argue that $20 to $30 is an attractive world for them to live in, but at the end of the
Certainly
day,
not.
I think most would say $40 and above is someplace they could operate and operate pretty reasonably. We have found that many of the shale producers that really created unstable balance sheets, if you will, have offered and created very exciting opportunities for the rescue lender, if you will. We made a $350 million loan to a company called Clayton Williams. Again, enormously productive for them to keep them alive, enormously successful for us as that business was able to deleverage and frankly make our investment several multiples of what we put in. So
incredible.
To us, that's a world. The rescue lending business in that industry is quite attractive. We would argue the oil and gas business for the U.S. And shale production will continue to be a core part of the energy industry.
Great. You don't see a burnout in 5 to 10 years. We're aggressively investing so much now. It's a free market, so everybody's going full throttle. We've increased production on a daily basis by 5 million barrels in 5 years. It's like adding another Iraq plus to the market. This is sustainable, Josh, in your view?
Demand has grown as well, notwithstanding electronic vehicles and so forth, which we heard about this morning. Look, what we found was the immediate transition from $100 plus to $30 minus created a lot of balance sheet that couldn't handle the stress. The fact is that a lot of very inefficient shale producers have become a heck of a lot more efficient. Like any industry, over time, you double production and costs decline a certain amount, and that's clearly taken place. For us, there's not a lot of margin in trying to predict energy prices in a way that's going to be superior to what the futures curve is already predicting. What we'd much rather do is focus on situations where there is that distress, where there is some chaos going in because of the transition, and we can focus on companies maybe in the service sector, companies like Transocean, Ocean Rig, Pacific Drilling, and others, where you can buy distressed debt from holders who can't handle it because it's going through a bankruptcy or through a restructuring, yet they still have a very valuable product where you can create rigs at, say, a half of what they're trading at in an unstressed balance sheet that doesn't have leverage. Jamie was pointing out the risks when you have leverage are much, much worse to a bank when you don't. The same is true with operating companies. So for us, we don't really like to put ourselves in a position where we're forced to outguess the commodity curve 5 years in the future. 5 years is a long time in our business. But for service companies, as opposed to upstream companies, for some of the midstream companies, and occasionally for one of the distressed upstream companies, if you take advantage of situations that are in that state of disruption because their balance sheet just couldn't handle the transition, you can create those 50 cent on the dollar assets. And that's really where we focus, as opposed to trying to have a more macro view of that.
Great. So before I'm going to go across the panel here because of your expertise, and then ask you about disruption, and then how disruption creates opportunity, even from a banking standpoint, because such a radical change, a huge equity fund managers, another play here. But I wanted to ask you, at this stage of where we are today, let's just go across the table and see, this is what we've seen in Saudi Arabia, $45 billion going into a big technology fund, $20 billion going into a big infrastructure fund. This is a major transition that's taking place. Can you make that transition from a oil-based economy to one that's much more diversified and not expect any radical bumps in the road? Do you want to lay it on? What's your impression? You said you've been here for a long time, Josh. Love to get you to jump in, James. That's what they're looking for. They're looking for the best minds to help in the transition. They know the work that's on the table.
Look, any transition can be disruptive, and it certainly seems like in the economy here, we've now seen change both in the way asset management has taken place. I'm sure all of us have experienced the incredible growth and sophistication of asset management in the Middle East generally, in Saudi Arabia specifically. Wow. But now we've also seen the birth of King Abdullah University, which is an incredibly sophisticated place where the first president came from Caltech, where he was president prior. So change is never easy. But now we're seeing a lot more from the top down that we're talking about here in this conference. And I think that's a good thing, and I would be optimistic about that. Okay, good. Your insights on this, James, as they make this transition?
One of the things that we heard about this morning was that people thought the 21st century, in the poll that they asked the audience this morning, that people felt that technology and change and disruption was going to be the most prominent feature of the 21st century. Now, I think technology has been changing our world forever. And industries have had to adapt to that forever. And so I don't know why today is necessarily any different.
I think it's the pace of change, probably.
From past periods of history.
But don't you think it's the pace of change?
The pace seems faster to us, but I don't know if it really is, or that's just our impression of it because we're living it today. But when you read back in time and look at the history, some of the disruption that was occurring, the automation of farming and agriculture, disrupted jobs on farms, throughout the world, particularly, I'm thinking of the United States, and all those jobs were lost, and people found new jobs. I don't know that people at the time said, "Oh my gosh, this is happening just slowly, and it'll be a gradual adjustment." I think it was probably pretty abrupt for people living through that period who depended on agricultural jobs for their own living. So I don't know. I mean, I think I have that sense too that it is happening faster, that everything's moving more quickly today, but I don't know that we should be so fearful of technology and the change that it brings, because I think it's been eliminating jobs today, but it's creating new jobs that didn't exist years ago, and that's opportunity. That's opportunity going forward. So I'm a little bit more sanguine about it all.
Well, it's interesting because I've seen the surveys recently. I read 4 of them because I was just chairing something on this in the last month. They're looking at displacement of perhaps 350 million jobs over a decade. So the U.S. produces, as you all know, about 1.5 million jobs a year. It's the largest economy in the world. So as you said, you have to create new jobs.
Well, it really creates more than that. That's 1.5 net jobs a year.
Yes.
A lot more jobs are destroyed in the United States, and a lot more jobs are created in the United States. I think in the tens of millions, so maybe 20 plus million jobs are created every year, while 20 are destroyed, 21.5 or some number. Don't quote me on those facts, but there's a lot of job creation beyond just the 1.5 million net new jobs that we see.
Very good point. So I want to get to the disruption. So David, do you want to jump in? If you're going to pick, because this audience is looking for how to make money in different areas that emerge partially because of disruption, what's the biggest thing you're watching as an investor today for disruption and that you are actually making cash decisions on, shall we say?
Right. So I think disintermediation is a huge theme going forward pretty much across most industries. And one thing that hasn't been widely discussed, probably because very few people understand it yet, is blockchain technology. That has a lot of application.
Which one? I didn't quite hear you.
Blockchain technology.
Oh, blockchain is interesting, yes.
And what's prominent in the press is all about currencies, which is a different topic. What I'm talking about is the application of that technology to many, many industries and the disintermediation of either existing players or players that have to disintermediate themselves. I think that is a huge theme going forward as companies reassess, even in the financial services industry. I think I read recently J.P. Morgan, I know, is up to doing something in that area. As are others. And if you're in an industry and you're not looking at that technology and the application to it, and you're a leader, you're missing something because you could get disintermediated.
Excellent. I almost describe it as the end of the middleman, because if you think about shipping a container from China to the port of Los Angeles or Long Beach, blockchain will radically revolutionize contracts as we know them today. Rengang, do you want to share your thoughts on where you see disruption, perhaps in the media space? It seems like a lot of disruption. Our business has changed radically in the last 5 years.
Yes. So on disruption...
Can we keep that microphone a little bit closer for you?
That's so great. On disruption, as an investor from China perspective, we are mainly focused on 3 things. First of all, is the new markets, as I just mentioned. Those underserved, market potentials. For example, like urbanization, like the consumption upgrade. That's one thing. So we did a lot of investments in those areas, very successful. Second area is technology. So, for example, I'll give you an example. We just invested into a local mobile platform. And that mobile platform, actually, they used AI, artificial intelligence, to increase the efficiency of learning English. And in a very short term, like just 1 year, they accumulate more than 40 million paid subscribers. And in the near future, they will expand to other language, not only English. So I think the technology is really play a very significant role in build up the whole infrastructure for the media ecosystem and also creating a lot of new business models. The third area we are focused on right now is the new consumers. I refer to the millennials. I think the consumption pattern and the pattern of those new new generation, younger demographic, actually creating a lot of opportunities for investments.
Okay. We have, again, you guys as the bookends to my great panel here. Two people are invested in the retail space. Tony, your group, if the information I'm reading is old, Neiman Marcus, 99-cent stores. Lately, I live in Abu Dhabi and spend a lot of time in Abu Dhabi and Dubai. I could never see the death of the shopping mall because of the heat. People like to congregate. It's almost like the 21st century Agora in our part of the world here. But there's some stress in the United States when it comes to retail space. A lot of disruption from the likes of Amazon. How are you playing disruption in retail? So
disruption, again, whether it's retail, whether it's healthcare services, whether it's oil and gas, I guess to James's point, I'm not saying technology hasn't been around, except now the response time, I think, has been made much shorter for many types of companies. In retail, as an example, we own a company called Floor & Decor, one of the largest flooring companies in the world, without intermediaries in terms of how they source. And then, of course, Neiman Marcus, that really has to respond to the online shopper in a way that they never anticipated. And the types of shopping going on and the amount of returns going on and the premium shopping online that many didn't foresee, all of that, again, has to happen in a much, much shorter, or I should say response to that, has to happen in a much shorter time frame. And again, those retailers, and I would put Neiman in that category, that think they're fantastic in a four-wall bricks and mortar environment, online is something that is a huge part of the Neiman business today, over $1.5 billion of revenue, but how to make real money from the online business is a little different and takes a little bit of adjustment, I might add. So again, I think that the segue, the relationship to disruption in industries from technology requires a much shorter response time, at least over the 30 years I've been doing this. And we see that far more than just retail, but certainly retail is part of the eye of the storm, if you will. Okay, very good. You're invested in retail and taking a look at disruption. Josh, want to lay on what you're thinking?
Well, just to be a little bit, correct you a little bit, we have so little invested in retail right now. In my opinion, of the disrupted industries out there where there have been bankruptcies, and there's been a record number of retail bankruptcies this year, retail is the toughest one to get your arms around and have a confident opinion because the reason for the disruption is so fundamental that many of these companies literally don't have a reason to exist. So if you want to buy some debt at a huge discount and you're getting the benefits of liquidation proceeds and you're massively covered by the assets, that's fine. There are a few of those around, but truthfully, they're few in number. And the judgments that you have to make to confidently buy stress or distressed debt in some of the larger, more visible names, in my opinion, are judgments we're not that comfortable to make because not only we're not that comfortable to make, most of the balance sheets have not only whatever debt appears on the balance sheet, but they have all those store leases and everything else. And some of them are casualties not of their own problems, but of other people's problems. If you happen to have stores that are located in regional malls that are anchored by other more problematic retailers and they leave, all of a sudden you're sitting with the location and lease expense in a mall that's gone. It doesn't have visitors and it might not even be your own doing. So I'd say of the different disrupted sectors, that's about the most difficult one to look at. You're trying, again, in our business, you want to avoid the big flow-driven businesses. You want to avoid things that are valued because rates are low and therefore equity prices are up or real estate prices are up or whatever. So we're trying to find situations that people are forced to divest of, but where we can confidently buy something at a discount. That works a lot better in oil and gas services these days, frankly, than it does in retailing.
Great. Really interesting insight. Let's bring up grab your phones, please, now that we have a pretty full audience here for the polling question. I'm going to read out the question and then your choices, and then we'd have you make a choice and see what our panel has to say about it. What is one underappreciated area of investment that will gain more in prominence going forward? What is the one underappreciated area of investment that will gain more prominence going forward? Our choices are out here. Number 1 is commodities. Number 2 is real estate. Number 3 is angel investing. 4 is luxury goods. And 5, which has been covered by our panel here, is debt. underappreciated area of investment? Go ahead and vote, and then we'll get a signal and get a couple of quick comments here. So we have 14 seconds. And I want my panel to start thinking about geopolitical risk, if I can. It seems we've become very sanguine in the world about nothing ever going wrong, even with little Rocket Man. Can we say that? Let's get our panel. Aha, that's interesting. Did you see our results? 42%, underappreciated angel investing. Number 2, I think I would agree with that. Number 5 is debt. Rengang, would you want to jump in, Tony, very quickly, because we're almost at the end of time here?
In terms of
the results, what do you think? Angel investing is underappreciated.
Well, under the category of angel investing, the amount of dollars being put to work in that space is one it's just hard to have size.
Yeah.
Of course, on the debt side, it's the core of how we've built our business and the benefits of those investors that can take the long view, that can be illiquid in their approach. As I said, that can pursue many of the types of assets large banks once pursued. There's huge opportunity. If you think about it, as our earlier friends this morning described the future of the next 10 years in that 3 to 4% range, being in the illiquid credit space, it means you're being in the 8 to 12% rate of return. That's why we exist, and that's out there in today's world. Again, pursuing, if you will, taking advantage of that illiquidity and long view.
Great. Rengang, very quickly on angel investment. What sort of role is it playing in China with the companies you look at?
Yeah, we are doing a lot of angel investments in our focus sectors. However, our strategy is also it always focuses on the long-term, value proposition. I think that's our strategy.
Okay, very good. Final question. I'm just going to ask Jamie this. It seems like we don't factor in geopolitical risk today, that it all gets sorted out. And it's pretty noisy from 1600 Pennsylvania Avenue. That would be the White House. Whether it's North Korea, whether it's trying to break the JCPOA of the nuclear agreement with Iran, Iraq flared up with Kurdistan. These are not areas that will seep into the markets and rattle the cage like they have done in the past.
Yeah. Well, I think it's hard to tell whether or not geopolitical risk is ever priced into the market. And we were having this discussion a couple of weeks back, and one of my colleagues suggested that maybe it is priced in. Maybe asset prices would be a lot higher if we were living in calmer geopolitical times. The fact of the matter is that the world's leading economies, I think the top 40 or 50 economies are all growing. I think most of those have superior growth rates this year than they did last year. Most of those have superior growth rates forecast for next year than they have this year. Inflation remains relatively low. Monetary policy is still relatively accommodative around the world. The fact that asset prices are fully valued or richly valued, you could debate whether or not they're in bubbles or whatnot, maybe that all makes perfect sense in light of the state of the global economy today, even with what we all perceive to be some element of geopolitical instability. So I don't know. It's hard to assess what the right discounting is for some of these risks that occur today. I think in the past, if we look back over the last year, when we think about the effect of the Brexit vote on markets, when we think about the effect of the US election, markets didn't fall on the back of this news. And again, because the fundamentals didn't seem to have been that badly shaken in the short run as a consequence. So earnings are still growing, and I think as long as earnings grow, that's very, very good underlying support for equity prices.
That's a good place for us to finish, but thanks to you on the panel, I feel much better about artificial intelligence. Technology is disrupting our life. I don't have anything to worry about geopolitics, and the valuations are high, but we could be in the sweet spot for 5 years. Not bad, right? You believe that?
I mean, not 5 years.
Okay, nice round of applause for the panel. Thank you very, very much, and appreciate the feedback from the audience.